In my view, what broke wasn't just the prices, also the entire infrastructure cascade that crypto markets actually rely upon. Many of those altcoins are essentially tradable, yes, but during stress or tail events, no, mostly no. The United States is launching new operations against Venezuela under the pretext of drug enforcement and fighting drug cartels, but this is transparently about oil. The Japan-China tensions, diplomatic tensions, in my personal opinion, are reaching maybe even critical levels. The longest government shutdown in the history caused a long period of data blackouts that Jay Powell needs for his decision-making and assessment of the situation. There is no data, unlike with Bitcoin. Bitcoin, despite these conditions, still maintained liquidity and functionality and tradability.
Hello, everyone. Today, I'm joined again by Igor Hadziahmetovic, an investment director and portfolio manager at Venionaire Capital. We're recording this on November 28, 2025, and the crypto markets have been going through tumultuous times, right? Quite a period since our last conversation in July 2025 as well. Since early October, Bitcoin pulled back significantly from the all-time highs of 126,000 to 92,000. We experienced what many are calling the largest liquidation event in crypto history on October 10th, 2025. And ripple effects are still being felt across markets, right? Not only in crypto markets. Today we will unpack what happened, explore a broader macro and geopolitical context, discuss how institutions have responded and their adoption trends as well. We will also look on what's ahead as we close out 2025. Igor, thank you for joining me today.
Nice to be here again. Thank you for having me back after a couple of months. It was a rough 6-7 months for crypto markets and TradFi markets as well. We've seen a 35% drawdown from those October highs that you mentioned. Peak to trough. But this, I would say, isn't just a simple price correction. I would even dare to say it's a complete reset of market microstructure. So the October 10th flash crash was the catalyst and had its own catalyst, but maybe we'll talk about it later. We saw 19 billion in officially reported numbers, liquidations, but the unofficial estimates are actually between 30 and 40 billion. So it has to do with how exchanges report liquidation numbers. Open interest on major exchanges dropped roughly 50-55% on average. And it is factually the largest deleveraging event in crypto history. So what made it particularly severe was, I would say, the positioning going into this event. Funding rates were extremely high, extremely elevated. And of course, open interest was also at record levels. And everybody who wanted to be long was already along with heavy leverage. So of course, when you have that kind of setup, you are vulnerable to sharp corrections, even without fundamental changes or changes in fundamental quality of the assets you are invested in. So since that flash crash, I think we have been slowly rebuilding. Liquidity providers pulled back. Some were not operational. Leverage definitely got flushed out, and positioning normalized. We also seen some institutional pullback. Maybe we can discuss that point as well a bit later. And some reports suggest that Wall Street firms reduced actually their exposure by around 5 billion at that time of reporting. So that includes also positioning in vehicles like Michael Saylor's strategy and the likes. So maybe like the key point for me, the fundamental thesis has not changed. Bitcoin's properties such as inflation hedge, limited supply, institutional adoption, and characteristics of both store of value and risk on asset, all of that is intact at 80,000, at 90,000, same as it was the case with the 126,000 back in October. So what's changed is this positioning and short-term sentiment changed. From a risk-reward perspective, cleaner positioning actually creates opportunity for those allocators that are disciplined. So, I mean, as we all know, market is maturing, and different demand structure that we have now is different than what we had a few years back. So we have spot-based institutional adoption as a part of leverage. Part of it is also leverage-driven retail, but also spot-driven institutional exposure. That's what I'm trying to say. You have this both components playing, or both components are at play, and both are essential for the market to mature further and to grow further.
So Bitcoin has reached $126,000, right? That was Bitcoin's sixth all-time high of the year with quite a strong momentum. So what happened over the past 6 weeks, right? And how do you characterize the shift in market sentiment and structure?
Well, a lot of things actually happened, so it's going to be maybe tough to unwrap this one. What broke, in my view, wasn't just the prices. It was the entire, also the entire infrastructure cascade that crypto markets actually rely upon during stress times and also during normal, let's say, operational conditions. The initial trigger was that we had a sharp Bitcoin drop that was on the back of some statements from Trump regarding tariffs, basically escalation of tariffs, conversations and discussions with China. And that Bitcoin drop hit actually heavily over-leveraged long positions. And the real damage came from what happened afterwards, meaning the market makers, the companies who provide liquidity and maintain order books, they started stepping back and or were simply not operational due to technical, let's say, malfunction generally. I'll maybe come to that. And they weren't able, some of them were not able to operate properly, and tech backend was just unresponsive. So, you have a liquidity providers, let's say, pull back in general in a market that is 24/7, like, around the clock. So there is no circuit breaker. There is no, how do you call it, trading halt as you have with TradFi. So the result is that the prices just gap. This created some form of a vicious cycle. Bitcoin fell, funding raise that had been extremely positive going into that event, suddenly flipped. Traders scrambled to try to close out their positions, but the liquidity wasn't there. The tech was not working properly, and slippage became extreme. You would try to exit at one price to close out your position, and you would get executed at 20, 30, 40% lower. So then exchanges started triggering something called auto deleveraging mechanism, which is essentially forced position closing when insurance fund of said exchanges runs low. So some call it as a nuclear option in crypto derivatives markets. So it means that the exchange cannot handle the losses that incurred so far through normal liquidation processes. Part part of that, or part of what made it particularly brutal, was that exchanges were using all sorts of altcoins and synthetic stable coins as collateral for cross margin. So, you have spot prices of said altcoins that were allowed to be used as collateral. Spot prices of said assets dropped like 50 to 80% within 15 minutes, which triggered ADL. And certain stable coins or synthetic stable coins as well simply depegged, which impacted the collateral value, creating a vicious cycle of self-reinforcing cascade. We saw correlated, actually very correlated failures across wrapped assets, wrapped tokens. We saw failure of Oracle-dependent protocols, meaning you have a price feed that lags or is just simply not available during extreme volatility. So this compounds this liquidation process and this liquidation cascade. So it was a multi-layered problem that spread out like wildfire. And you also had, of course, overcrowded long positions that I've mentioned. Everybody who wanted to be long was already long with heavy leverage. And on the back end was using actually garbage altcoins as collateral, which got hit very, very heavy, very hard. And combine that with false or missing price feeds and empty order books due to the withdrawal of market-making companies. In total, this hit the infrastructure really, really hard, and the infrastructure simply could not handle the stress that ensued. So the infrastructure is built for, let's say, normal conditions, not tail or outlier events such as we had with this flash crash. And in crypto, outlier events are happen on weekends. It's more of a normal occurrence, and it's very, very heavy when it comes.
Market makers are particularly stressed out during this event.
Yeah, definitely.
What role do market makers play in crypto industry? Right, not everyone really knows that.
Yeah.
And what does their stress signal about systemic vulnerabilities? Which are the vulnerabilities concerning the industry?
It's a good question. Something everybody heard at least once, but not a lot of people actually understand what market makers do, what their role is. I mean, market makers are the shock absorbers of crypto markets. Basically, they're supposed to provide, continuous two-sided quotes, meaning bids and asks, and they maintain orderly markets during normal and during volatility periods. So when they pull back and or cannot operate due to tech breaking down, then order books liquidity largely disappears. I mean, market makers also incurred heavy losses themselves. And of course, I have to say that traders, both big and small, also contribute to the order book depth. So not just market makers, but everybody together, let's say, maintains order books. But market makers has this specific role of providing double-sided quotes, or two-sided quotes. So during the October 10th crash, we saw widespread market maker, let's call it withdrawal. These firms ran into their risk limits. They couldn't hedge properly. And some stepped away, some got blown out. Without market makers, order books became very, very thin. Spreads widened dramatically. And price discovery, just broke down. Maybe one important key element here is that in crypto markets is the fact that we have thousands and thousands and thousands of different assets, altcoins. So market making all of them is a big challenge, resulting in thin order books. So many of those altcoins are essentially tradable, yes, but during stress or tail events, no, mostly not, as we have seen. So here is the maybe the structural problem that you referred. Crypto operates 24/7, but market makers, their risk management is still largely built on traditional finance principles, like position limits, value at risk models, hedging requirements, etc. So when volatility spikes, it is often the case in crypto, and asset correlation go to number one. Those models then tell them, reduce your exposure immediately and protect your capital. The current tech infrastructure system in crypto industry has no binding obligations for market makers to maintain quotes when you have stress periods, such as was the case with the flash crash. So unlike traditional exchanges, where designated market makers have certain explicit obligations, crypto market making is entirely or largely discretionary. That means that when things get ugly, they can just turn off their bots and just halt their operations. Mm-hmm. Why not? I mean, there's no accountability. There are no consequences in this context, as is the case with TradFi. So what that signals to me is I would call it fundamental mismatch. We are building, in general sense, we're building with DeFi and blockchain and crypto industry in general, we're building 24/7 global markets, but with largely 9-to-5 infrastructure and risk frameworks which were not developed or meant for digital assets as an asset class. Some of solutions would be maybe exchanges implementing something called like dynamic liquidity requirements, stress period obligations, for market makers, as I mentioned, better insurance mechanism on centralized exchanges. Otherwise, I'm pretty sure that we will just continue seeing these cascades and crashes, occasionally. Good news maybe would be that this is definitely fixable. It's not something that you cannot fix. It is fixable. Perhaps improved, rebates and maybe privileges that are tied to stress period performance of market makers. Maybe for retail traders and also institutional traders, improved ADL protection. Especially for market makers who maintain their liquidity and quoting during crisis or outlier events would help. Maybe also some form of penalties if they abandon that obligation. So I'm sure that some of the centralized exchanges are exploring these, optimizations in general, but they are also very, very big parties out there that certainly benefit greatly of these inefficiencies if they remain.
The phrase "we're building 24/7 markets with 9-to-5 infrastructure," it has been used to describe crypto's structural vulnerability.
Yeah.
What are the most critical infrastructure gaps this event exposed, and are we seeing meaningful fixes being implemented?
Well, gaps. There are a couple of gaps. Let me think about it. Static insurance funds, I think, would be one of those gaps. Most exchanges used or use fixed ratios to size their insurance pools. But the October event showed these are completely inadequate during extreme moves, outlier events. When you have 80 or 90% of positions that are long, and then the market crashes, no static fund can absorb that shock. So it would be helpful maybe to have something like dynamic insurance sizing that would be based on position concentration, cross-margin exposure, and also real-time market maker participation. I think that would be one of those gaps. Another gap is, I mentioned ADL. I think ADL gap, that ADL is portfolio blind. Current ADL mechanisms, they just forcefully close your positions indiscriminately without making any differences. And this destroys hedge relationship in the process itself. So if you're running a market neutral book, with longs and shorts, ADL might close your hedge and just leave you naked to a directional risk. An improved ADL mechanism would recognize these hedge relationships between deleveraging and offer maybe portfolio level ADL. What other gaps? Let me think about it.
And ADL stands for auto deleveraging.
Auto deleveraging. Yes, thank you. The third gap, maybe to mention, is this lack of accountability for liquidity providers. As we discussed, market makers can vanish during stress periods with zero consequences. Really, zero consequences. And when we talk about centralized exchanges, crypto markets need, I would say, binding obligations, at least on centralized exchanges that are regulated or heavily regulated, depending on the jurisdiction. So not just to have this, let's say, discretionary participation from market makers. I will participate now, but now I don't like to participate, so I will not participate. I don't care about the results or outcomes of my withdrawal. I don't think that is good for the overall health of the infrastructure and industry in general. So this is different from pulling your liquidity from a DEX or AMM pools, which is just different level of liquidity providing. It's just something else. So there are some fixes currently taking place. I would maybe say slow and steady. Some exchanges are discussing improved market maker programs, with the stress period requirements. Let's call it like that. As I've mentioned, this dynamic insurance mechanism is part of it, but I think implementation is slow and it will remain slow because, amongst other things, it requires good coordination among centralized exchanges, which are essentially competitors. And honestly, it costs money to build better infrastructure, but there's also a lot of money to be made. So some crypto industry segments, let's call them like that, segments or subcategories, they need maybe to decide whether they want to be taken seriously by professional investors or they want to remain just an on-chain casino for retail folks. So it is safe to say that real institutions will not allocate seriously until these structural issues are addressed.
From a risk management perspective, how has this event changed your due diligence framework or the way you think about the counterparty risk and exchange infrastructure?
That October crash reinforced several principles I've always held, but it also added some new elements to counterparty risk assessment. Specifically, for me, what trading venues and exchanges to use and for which assets to use. So, exchange infrastructure audits are, I would like to say, mandatory. I wish they were mandatory, and there are mandatory audits. But as you uncover more and more problems or issues as the market evolves and matures, you have to introduce new kinds of audits and quality control mechanisms. So I'm paying more attention to insurance fund transparency, ADL trigger thresholds. They are different depending on which venue you have your assets and trading activity. Of course, historical performance during stress events like this, because this is not the first one. It is the biggest one, but we have had so many over the past 7, 8, 10 years. And if available, I like to take a look at market maker obligations and liquidity commitments. But this is this moment when you say but. This information or some of this information is just not publicly available or has limited availability to certain parties and has definitely limited reliability. It helps if an exchange can show how they maintain orderly markets during tail events like this. But I have to admit that, or to remind myself and everybody listening, at the end of the day, all of this information cannot guarantee how everything works once the market is on fire. You can have all the audits, all the data, all the information, promises, guarantees, but when that moment comes and the stuff just doesn't work, then that's the real moment where you find out the truth. Another point that I'm now paying attention to is concentration risk across venues, which I would say matters more than it used to, matters more than ever. We saw correlated failures. When one major exchange, I will not name any exchanges. I have to be careful with my compliance department. When one major exchange triggered ADL, it cascaded across the ecosystem, and having diversification across uncorrelated infrastructure, I think it is a big advantage to have, maybe even critical advantage, and not just to have asset diversification. You have to pay attention to asset diversification and infrastructure diversification as well. In this sense, I would also mention custody and collateral management. The spot versus derivatives, how do you call it, division or divide, it became very strong during the crash period. Spot holders that had proper custody were not subject to forced liquidations or to ADL. Derivative traders on the other hand side, even with reasonable leverage, they got caught in this mechanism beyond their control. So maybe from a portfolio construction standpoint, this validates the spot-only approach for your core allocations. And derivatives have, of course, they have their role for strategic or tactical positioning or hedging. Yeah, but they also introduce certain counterparty and infrastructure risks that some or many investors maybe do not really appreciate. So I think that infrastructure is part of fundamental analysis. Maybe that's my own lesson for myself. Infrastructure that you use is also part of your fundamental analysis, not just the asset or project that you want to invest in. You can have the right view on Bitcoin or Ether or any other project out there with proper risk sizing and still get destroyed by exchange mechanics during stress or outlier events like we had. So I would say that this is not acceptable for institutional grade portfolios.
Let's talk about macro and geopolitical developments. What broader macroeconomic conditions have been shaping markets through October and November? And how do you read the current macro setup?
Oh, that's a multi-layered question. A lot of things happened. Yeah, I mean, okay. Maybe the United States. Let's start with the United States. The macro situation in the United States has become increasingly complex, at least from my point of view, and honestly, more challenging for risk on assets in a broader sense. I would call it an uncomfortable regime that we are in right now, where we have central banks of large economies worldwide. They have had rate cuts during or over the last 12 to 14 months, roughly. They had more cuts and higher cuts or greater cuts in total percentage-wise than the United States Fed. So the Fed delivered 2 cuts in this year, 25 basis points in September and October. And over the past few weeks, expectations of another rate cut in December have plummeted to around 30, for a short period, below 30%. So it basically means the expectations have just collapsed, which caused another market sell-off. And during this week, over the past few days, expectations surged back to currently something around 85%. So after some statements from some key Fed officials regarding the further rate cuts. So this uncertainty itself is very volatile, which makes the current regime, I would say, uncomfortable for taking on new positions. If you take a look at 10-year bond yields, inflation adjusted real yields, so-called TIPS, on a 10-year duration, they are down significantly now than they were earlier in the year. Significantly, I think around 20-something%. So these yield rates matter for investment decisions. When you're when you're investing, you have the information what you're probably to get out of that before and after accounting for inflation. So that's why you take a look at this number. It helps to understand, this number helps you to understand if cash, bonds, or risk-on or riskier assets are more attractive under certain market conditions. So the first rate cut that we've had in September drove markets higher, and this stayed throughout September, but has lost momentum over the past few weeks, 4 or 5 weeks, let's say, and now it seems to be picking up again. So U.S. equities are back, almost back at all-time high, roughly 1.5% or so below all-time high, which is essentially good, but it highlights this volatility and uncertainty of volatility of uncertainty when it comes to U.S. monetary policy and the expectations from the markets. So at the same time, you have in the United States, their core inflation reading, they remain sticky. This means that inflation is not really coming down. And this is particularly the case in services industry. So the Fed is in a tricky position. And they are cutting rates maybe too late and too slow into what might be persistent inflation. And at the same time, they need to pay attention to the U.S. economy strength and U.S. economy growth, given the revised employment data. So this also matters for crypto industry, or for crypto specifically. It matters because Bitcoin's correlation has been changing as well. So in the first half of the year, Bitcoin traded more like, let's say, digital gold. It benefited from this inflation hedging demand, and it moved inversely to real rates. We also had, tariff policy shocks mid end of first quarter, early into April. So post-October crash, we've seen that Bitcoin behaves more like risk asset again, selling off with tech stocks and response to these liquidity conditions. So in our last talk, I mentioned that I see Bitcoin having two characteristics: acting as a store of value, a digital gold, but also as a risk-on asset. So those are all the characteristics of Bitcoin, and during certain periods of market, let's say, cycles, one of those characteristics is more expressed than the other. So the other macro dynamic I'm watching closely is the long-term yield curve. This means the 10-year and 30-year yields of United States bonds have been, in a way, moving independently from the Fed policy, meaning, long-end yields like 10 and 30 years, those yields rise despite rate cuts, which is, let's say, a red flag for duration-sensitive assets. I mean, essentially, the market is saying, to the Fed, we don't really believe your inflation control story and your tactics and your approach. We don't really buy that it's working. So cash is no longer maybe trash in this environment, but it also, that creates competition to risk on capital allocation, I would say.
There have been significant geopolitical developments, including U.S. actions against Venezuela, also escalating Japan-China tensions. Right?
Yeah.
How material are geopolitical factors in crypto markets today versus a year ago?
I mean, you're right about that. Geopolitical risk has become materially more important for crypto than it was the case, 5 years ago. And we are seeing now two major developments in this context that the markets are maybe underpricing at the moment. You mentioned Venezuela, so let's start with Venezuela. The United States is launching new operations against Venezuela under the pretext of drug enforcement and fighting drug cartels. But this is transparently about oil. Venezuela holds 19% of world's proven oil reserves, which is higher than those of Saudi Arabia. Venezuela also holds 75% of South America's entire natural gas reserves. So United States officials themselves have openly, publicly stated that this could generate, if I remember the statement correctly, that this could generate over $1 trillion in economic activity for American oil companies. So if this situation escalates to a military conflict, I think that we would likely see significant oil price disruptions. Venezuela is currently exporting over 80% of its oil production directly to China. And who does not particularly like China? I mean, we already know the answer to that question. So this matters for crypto because oil price spikes typically trigger risk-off behavior across all asset classes. And we have already seen, immediate impact on oil prices so far. And I think that both TradFi and crypto would face headwinds from energy-driven inflation that would ensue, and you would also see broader geopolitical uncertainty. So, to just briefly comment on the situation with Venezuela, the other part that has my attention right now is the Japan-China tensions, diplomatic tensions, that are, in my personal opinion, are reaching maybe even critical levels. Japan's new Prime Minister, Takaichi, she made repeated statements on Taiwan issue that China considers treaty violations of treaties between China and Japan from mid and end of 70s. And she, Minister Takaichi, Japan's prime minister, she plans also officially plans to deploy short-range missiles. I think it's called Yonaguni Island, which is like 100 kilometers from Taiwan.
Mm-hmm.
So China has responded with diplomatic, let's say, statements, asking for apology, asking for official public change of attitude. But China has also responded with economic certain pressure, let's call it pressure, meaning restricting travel, limiting Japanese imports, which could cost Tokyo alone around 14-15 billion US dollars annually.
Mm-hmm.
So together, Venezuela and Japan-China situation matters because it's disrupting major economic flows between the world's second and third largest economies.
Mm-hmm.
So we're seeing it play out, let's say, amongst other things, also in currency markets. The Japanese yen has been pretty volatile. And Japanese equities took a sharp hit from those, from the diplomatic crisis that started briefly. I wouldn't say in danger, but in some sense, yes, also in danger the economic outlook of Japanese stocks. So for crypto, this creates, let's say, two channels of impact. You have direct risk-off pressure when those diplomatic tensions spike. And you have also longer-term questions about Asian capital flows into digital assets. Because if everything is let's say, risk-off due to tensions, this will also impact the capital inflows from Asian countries into crypto industry. So we all remember the spike in tariffs or tariffs-related tensions between Trump and President of China, President Xi, in early October, which was actually the catalyst for this October flash crash, which was in of itself catalyst for system-wide, breakdown, which we already discussed. So versus, I don't know, compared to the last year, what changed is that geopolitical risk, I would say, is now multipolar and immediate. It's not more of a theoretical threat or a theoretical risk that you observe on as a side quest. Ukraine is a known factor that markets have largely priced in. It's a known issue. It's been around for, let's say, some longer period. It's nothing new in this sense. So Venezuela and Japan, China situation, that is, those are developing stories with material economic consequences. Oil supply disruption, and you have potential Asia trade war scenario. So I would argue that this traditional statement that you hear sometimes, crypto benefits from chaos, I think that narrative, that mindset is maybe too
it's overstretched.
Too simplistic. I would say it's too simplistic. Yes, we might see some capital seeking alternative to traditional systems. So you would have a certain risk takers under those turbulent conditions. But the immediate effect of geopolitical escalation is usually risk off, risk off across all speculative assets. You have like flight to safety, and you're escaping any risk exposure. So Bitcoin currently trading at 92,000 roughly is slightly negative year to date, but it is much more or significantly negative compared to Trump's inauguration sometime mid-January. And this tells you something about how risk appetite has shifted. For investors, I mean, maybe the key is recognizing that geopolitical risk has now a direct transmission mechanism into crypto markets through, amongst others, oil prices. So you have one of those, let's say, routes is Asian capital flows, and then you have the broader risk sentiment in general.
Sometime around September, me and you will discuss the Fed's difficult position with sticky inflation despite rate cuts.
Yeah.
How has that macro narrative evolved since then, and what's your outlook heading into 2026?
I think that their position has actually become more difficult, not easier, over the past 2-3 months. In September, when we got when the markets got this first rate cut, the market was, I think, pricing in sort of a smooth path, meaning we'll get gradual rate cuts going into the end of the year. Inflation is going to continue cooling off. There will be no hard landing. So in a way, the consensus view was or has been challenged since then. We are now seeing a scenario where the Fed might be cutting into persistent inflation, which is not coming down. And at the same time, you have U.S. Economic growth weakening or is weaker than the official data suggested. The Fed chair, Powell, Jay Powell, as he's often referred to, he every time there is a press release, he stressed that or highlighted that they are making their decision based on facts and data, and they are using data and waiting for data to make new assessment and new decisions, and so forth. But the jobs revision story that I briefly mentioned earlier, I think is one of critical 2 points here. If the United States employment or labor market was never as strong as reported, then the Fed might be behind the curve when it comes to supporting growth and not ahead of it. So, I mean, they also cannot cut aggressively because inflation hasn't convincingly broken down, is not decreasing. So adding to this challenge is this U.S. government shutdown that we also had in the meantime, which was the longest government shutdown in the history, which also itself caused a long period of data blackouts, meaning you do not have available key economic data that you need and that Jay Powell needs for his decision-making and assessment of the situation. So there is no data. I think this is where any move by the Fed carries significant risk. If you cut too much, instead of 25 basis points, you cut, 50 or 75 basis points. If you cut too much, then you risk reigniting or supporting inflation's growth, and you want to achieve the opposite. But if you cut too little, meaning 0.25 or 25 basis points or no cuts, no further cuts, then you might tip a weakening economy into recession. And I don't think that recession is as realistic, but it is one of those things they have to pay attention to. So for crypto and risk assets broadly, I think this is a challenging environment. The markets, let's say almost, maybe to put it in these words, the markets relied with heavy conviction that the Fed is going to start cutting rates. And this conviction is now less reliable, I would say, because the Fed is facing or navigating conflicting signals. We have already seen this play out in a way. Risk assets sold off even as the Fed was actually cutting, which is historically unusual. Everybody was waiting for the opposite reaction, and it didn't materialize. So my base case for 2026, I think, is definitely continued volatility in both macro policy, market, and market pricing in general. I don't think that we are heading into a up-only scenario across asset classes. Maybe it's more likely for the next 2 to 4 months that we are in for a let's say bumpy ride with regime shifts. You will have periods. I expect periods where crypto assets or some crypto assets trade as an inflation hedge, but will be interrupted by risk-off episodes or periods where you just have sell-offs in tandem with equities. Mm-hmm. So you will have periods of correlation with equities. From a positioning perspective, for me, this means being more tactical, strategic about it than having a dogmatic vision, being just running with your head against the wall. The buy and hold thesis for Bitcoin still works for long-term allocators. I am further convinced of this. I'm not questioning this. But for anyone who is managing shorter-term capital, I think that you need to be more dynamic in the context of sizing and hedging. There is no predicting anything. You just can anticipate certain outcomes, certain scenarios playing out, and you try to build portfolios that are ideally resilient to multiple scenarios. So in this sense, you are more prepared to those scenarios that have the highest probability of playing out. And there is no predicting when it comes to investing or trading or in this sense, macro developments.
We have discussed in the previous episode Bitcoin's evolution from a risk asset to store of value. The October crash saw Bitcoin drop sharply, but also recover more steadily than many altcoins. How did institutional holders and ETF exchange-traded funds flows behave through this volatility?
Institutional, for me, based on my observation at least, institutional response through October has been more resilient than I expected, given the severity of the crash. It was very, very the biggest liquidation event in crypto history. So Bitcoin ETF flows did not see panic redemptions. Yes, there was volatility and, of course, some outflows during the worst days, as well as in this month. Over the past 3 weeks, I think roughly some 4.6 billion or something like that, around 4 billion redemptions in November so far. But in my view, this is nothing that is not resembling capitulation. I would not say that. The spot ETF structure actually proved its value, in my opinion. Holders could not get liquidated. They did not get any exposure to ADL fallout. and they didn't face counterparty risk from exchange failures. So in this context, I think ETFs proved their value. But what we saw was also a clear differentiation, I would say. You have retail got crushed, over leveraged perpetual positions, altcoins exposure, and not just any altcoins. Even certain stronger projects were just too much leverage, and exchange concentration risk, and you end up getting hurt. Institutional holders that have proper custody frameworks and spot only exposure, I think they weathered this crisis much better. So interesting dynamic for me is that institutional adoption in the United States is accelerating. It's not slowing down, retreating. We are seeing in the United States some 55% of traditional hedge funds that now have exposure to digital assets in 2025. In third quarter of this year, VC investments into crypto were around 4.6 billion just in the third quarter. So to me, this looks like money is building positions and not money fleeing or abandoning a sinking ship. But yes, you have to admit there's also risk adjusted rebalancing, which is warranted. As I mentioned, so far in November, there were around if I'm not mistaken, 4.5 or 6 billion in ETF, Bitcoin ETF redemptions so far. And when you take a look at this number alone, it's like, wow, 4,000 million in redemptions only in 3 weeks. But the assets under management is still around 125 billion. So it's like, it's not a capitulation in of itself. So you have to have this proper context when you do observe certain data points. Part of this, or if I remember a question, I would add to this DAT companies, meaning digital asset treasuries. This trend is, I think, particularly noteworthy. Companies are increasingly holding Bitcoin and some other assets on their balance sheets, not for speculation, but as treasury management. Inflation hedging, tax efficiency, maybe liquidity optimization. Using stable coins, USD denominated stable coins for treasury management purposes is maybe not the same thing, but is also happening due to change in regulation in the United States. So I think this is also a big step in the right direction. But to stick to Bitcoin and majors, altcoin majors, you have institutional Bitcoin holdings across asset managers, hedge funds, corporate treasuries. They have more than doubled since November 2023. So it's like 2 years period, you have more than doubled the exposure, which I see personally as a good indication of that is in favor of this trend staying and growing stronger. What did change is, I would say, quality of adoption. Early adopters in crypto were, crypto native firms, high net worth individuals, early crypto or tech enthusiasts, and smaller companies in this context. But now we are seeing traditional corporates actually building allocations for Bitcoin, for Ether, for Solana, which is a totally different structure of demand side. So you could say that what happened in October, this October crash, was perhaps a positioning reset. In my view, it was not a fundamental shift in how in institutional conviction. I don't think that institutional conviction changed because of this crash. So, if anything, it validated that or confirmed this spot-only approach I mentioned earlier, and confirmed that having proper infrastructure is a vital prerequisite for the future growth and development of crypto industry in general.
Wall Street firms reportedly pulled back around $5 billion in crypto exposure, with major institutions reducing Microstrategy or strategy positions. What does this institutional behavior tell us about where we are at in the adoption curve?
The $5 billion pullback that you're mentioning, I mean, it is real, but again, as mentioned in the previous question answer session, context matters. Really, context matters. So, in my view, this is primarily exposure reduction through leveraged vehicles and derivative products. It was not, abandonment of digital assets. Nobody's like fleeing in this context. So, strategy or MicroStrategy, I would say it is it is an interesting case study. It's essentially a leveraged Bitcoin proxy play. The company holds massive Bitcoin positions that are funded through convertible debt and equity raises. So after Bitcoin crashed in October, before that, MicroStrategy or Strategy's equity was having a pullback. But after a Bitcoin crash in October, this pullback, meaning Michael Saylor's or MicroStrategy's equity, sold off hard, in part due to the leverage amplification. I mean, traditional asset managers who held MSTR equity or stocks as a way of indirect Bitcoin exposure, they got hit with equity volatility because, as mentioned already, there were pullbacks. And then on top of it, you had the leverage risk. So in a way, it was like doubled. The effects or the outcomes were doubled. So to me, it says that in a way, institutional adoption is maturing, is differentiating. The first wave was like get exposure however you can. For example, if you remember grayscale premiums, then Michael Saylor's strategy stock, then you have futures, then whatever worked. But I dare to say that this era, this approach might be over. The pullback in leverage exposure is actually very healthy for long-term adoption. So it removes that short-term, unstable, highly speculative capital allocations. I think that I have how to put it in another way. That for me, the institutional adoption is not something that is linear. It comes in waves. Each wave has different approaches, mechanics to a different level of sophistication than the previous wave. So the first wave was, let's say, exploration and opportunism. You start, take a look into Bitcoin and then understand Bitcoin and get exposure to Bitcoin. Then you start learning and assessing other opportunities beyond Bitcoin. Then you get exposure. And in this context, I would say, exploration and opportunism. But the second wave is, in my view, institutionalization of infrastructure. So I think that is the wave that we are currently in right now, which is in total a different approach to get exposure and has different time horizon focuses on different time horizons. So this $5 billion pullback that you are mentioning is, in my view, it's just noise. Comparatively, to put it into relation in context, it's just noise. It's not much. The signal is, for me, this structural trend. As I mentioned, we have in the United States 55% of hedge funds with exposure. You have billions in VC funding per quarter, and you have crypto treasury adoption. This is growing. So that is what's a signal to me. And this 5 or even 10 billion would be, in the grand scheme of things, just noise.
You have emphasized that Bitcoin buy and hold has been hard to beat and warned about the graveyard of dead altcoins. Has the recent volatility reinforced or challenged this thesis?
The October crash, I think, absolutely reinforced this thesis. Perhaps more clearly and strongly than any previous event. And as I said, over the 10 years, we had so many such outlier events. But I would look at the divergence. For example, you have Bitcoin dropped like 35% from the highs from early October, which is in of itself not really much. It's like normal correction during bull market periods. Just, when you take a look at the corrections historically, 35% is okay. It's not like end of the world. But in the broader picture, Bitcoin maintained liquidity. Exchanges, kept functioning to a larger or greater extent than for altcoin spot markets. So infrastructure, in this sense, for Bitcoin, largely held. Altcoins, many altcoins experienced like complete, liquidity collapse. Wrapped assets, depegged Oracle failures, as I mentioned, which just amplified and exacerbated this cascade throughout DeFi protocols. So just not like it not only centralized exchanges were affected, but it was like system-wide cascade. And tokens that were maybe top 50 by market cap, or majority of them, became suddenly entirely untradeable. Unlike with Bitcoin. Bitcoin, despite these conditions, still maintained liquidity and functionality and tradability. So this quote that you mentioned, graveyard of dead altcoins, it sounds like a metaphor, but is actually a reality that we all can observe. Every cycle, you have like 80 to 90% of altcoins from previous cycle just literally disappear or become worthless. That's why we have expressions like dead coins or ghost chains and stuff like that. The October crash, in my view, just accelerated this, process significantly. Bitcoin's buy and hold strategy or thesis remains strong, very strong in my view, due to the fact that you have for Bitcoin the deepest liquidity, the most robust infrastructure, the clearest regulatory roadmap or pathway, whatever you want to call it, and you have also the strongest institutional adoption trajectory. When markets break, obviously Bitcoin breaks less than altcoins, and when institutions allocate their capital, they start with Bitcoin. So when regulations are about to be approved or get approved, or regulators approve new products, Bitcoin comes first, So that does not mean that altcoins have no role, that they have no value or no use cases. I mean, that would be a lie, and it would be very ignorant thing to say. Which altcoins are better positioned for what for and why? That is the question for me. The key question when you want to look into altcoins landscape. There are dozens of altcoins categories within crypto industry, and not everything is to be assessed or evaluated with same lens. Compared to Bitcoin, the risk reward for long-term holding is, I would say, asymmetric for altcoins. Bitcoin is a credible world reserve asset. It is a treasury holding for corporations. It is a proven inflation hedge, and so on. But most altcoins simply do not have this positioning. They do not have these key characteristics or advantages. But in my view, altcoins, generally speaking, do have is a path to zero. The recent volatility, showed this in real time. So you have spot Bitcoin holders that have, let me reframe this. Spot Bitcoin holders that have proper custody were fine. They just, they just had to stomach the volatility. And some of those Bitcoin holders are new, got into the game due to wrong reasons, with different mindset, with different time horizon. And this kind of volatility, minus 35% was suddenly like, wow, it's too much. So some of them had no problem stomaching this volatility, but some of them were freaking out and panicking. So altcoin holders, generally speaking, faced, let's say, delisting risks, DPEG events, protocols failures, protocol and DEP malfunctioning, and permanent capital loss. So it's not really directly comparable. If you say you see yourself as a disciplined investor, then for you as such investor, it's clear for you that core allocation in your portfolio belongs to Bitcoin, meaning Bitcoin is part of that. And, given the proper infrastructure, as I mentioned earlier, with venues and which infrastructure you're using to maybe custody services. So there are more elements to it, but core allocation, in my view, belongs in Bitcoin with proper infrastructure. I would say that altcoins maybe are more a strategic services, product-oriented assets, like in form of projects. That do require constant monitoring, constant assessment and reassessment, because oftentimes their failure is fundamental. It's not just price-based, but you have to pay attention to certain fundamental aspects that you have to reassess and monitor and track and just stay on top of things and on top of development, which is not as the case for Bitcoin, for example. So the thesis about Bitcoin having, properties of both risk, asset, and store of value isn't theoretical. I mean, we can observe that thesis in institutional behavior, in capital flows, regulatory treatment, definitely. And of course, performance when you have market stress situations like we did in October.
Looking at correlation dynamic, during the crash, we saw that what some called correlation goes to 1.
Yeah.
Not just in prices, but also in operational failures.
Correct.
How should investors think about diversification in crypto given systemic leakages?
Again, what happened in October, this October crash, in a way exposed fundamental truth that, to me, this truth is that traditional diversification does not work in crypto the way it does in traditional markets. When the crash hit, we saw price correlation basically go to 1, but we also saw something that I can describe as operational correlation. As already mentioned, Oracle failures, cascades, and multiple protocols were just simultaneously not responsive, were not functioning. Assets depegging, stablecoins depegging, improper or lagged price feeds, and so on. Market makers also withdrew from multiple venues at the same time. And within few hours, exchange insurance funds got depleted, and ADL triggered across platforms. This is traditional. This is different, fundamentally different from traditional markets, where during market stress you might see correlations temporarily between assets, but the infrastructure remains independent. So in crypto, it became clear during and after the crash that the infrastructure itself is heavily correlated due to same Oracle providers, you have same liquidity sources, you have same counterparties, you have same custody chains, you have same market makers, etc. So the reality is for me that if you're holding let's say 10 or 15 or 20 different altcoins, it does not always give you this a level of diversification. If all of them use, for example, same Oracle system or trade on same exchanges or rely on the same market makers even. Yes, you have position diversity, because you are not only investing in a asset, in a single asset, but you still get to keep sounds funny, but in this context, it gets to keep unchanged structural concentration risk. Mm-hmm. You have removed the concentration risk when it comes to assets, but structural, operational, technical, let's say, infrastructure risk is fully concentrated. So this infrastructure diversification needs to be, I would argue, a part of your fundamental analysis and just how you want to approach your risk management, in addition to just asset diversification. For example, you have, I mentioned custody diversification. Don't concentrate assets on a single exchange or with a single custodian if you are using custodian services. Just if it's possible to you, if it's possible to you, just use multiple providers as many as you can, with paying attention to this independent operational infrastructure. It does not make sense for you to have multiple providers that on the back end use the same operational infrastructure. So as far as you can get the information, get the data, verify it, and then try to create a higher level of independence also in this context. I think I've mentioned something with regards to centralized exchanges, meaning venue diversification, which I pay attention to as part of my process. So try to execute across exchanges that have different ownership, different jurisdictions, different technical architectures, but you might not be able to do that depending on your jurisdiction or what you are allowed to do with, let's say, a regulatory framework that you have to pay attention to, or this advice is like, what works for you. Think in this direction and see what works for you and what of this approach or strategy you can implement. As mentioned, I mentioned also this asset level diversification. I mean, to repeat or to reiterate, you have to recognize that Bitcoin has fundamentally different infrastructure robustness than many altcoins. I would argue that Ether or Ethereum blockchain has a very high level of infrastructure robustness as well. And Bitcoin liquidity held very well during the crash. Spot markets for Bitcoin functioned better than for everything else. And many altcoins completely broke down. So you have to pay attention to this as well when you are, building portfolio, just building your basket where you want to put your money in. So you got to diversify what actually matters to you. You know, not just having asset exposure, but also paying attention to different operational infrastructure. This is also kind of exposure you have, not only to asset classes, but also to operational infrastructure. So do that as best as you can. The structural independence can sometimes be of greater value than to have asset correlation, high asset correlation in short periods of time when you have outlier events.
As we head into year-end 2025 and early 2026, what are the key levels, catalysts, and developments you're watching most closely? What would need to happen for you to turn more constructive on the market?
Bitcoin is currently at 91, 92K. I think this is a level where it's testing critical resistance around this level. I think that we need to hold the 80, 85K range in order to maintain bullish price structure on a high time frame basis. I think break and hold above 95K would signal, or it would signal to me that the October lows are in, and that this was capitulation, and that the positioning has reset in a constructive way. Below 80K, I think we're likely retesting some lower levels, and at the moment, I do not see this as a realistic scenario in the short term. As long as we hold high 80K range, 88 to 90, we still have a good chance to regain 95. And if that happens, then, reassess the situation and see how the chances are that we are going to continue towards 100K, which is a psychological level. You mentioned structural developments.
Key levels, catalysts, or developments.
The most important catalysts, I think for me at least, are this regulatory, constructive regulatory support and regulatory clarity coming out of the United States, and further infrastructure improvements. I mean, we have, I think since early September, if I'm not mistaken, new SEC framework, the Securities Exchange Commission in the United States, and their decisions on altcoin ETFs applications based on those new rules are something to watch very closely. Solana, we got it. Litecoin, we got it. Ripple, we got it. Approvals signal, I would say, these ETF approvals based on the new scheme, in my view, signal broader institutional access and could unlock significant capital. I think in the next year we are probably going to have at least 50 to 100 altcoin ETFs. Clarity Act in the United States and some other market structure legislation that is in preparation, in total could provide these regulatory frameworks that institutions need in order to allocate more aggressively with much higher allocations that we currently have. So exchange infrastructure improvements, yes, that matters as well. And I sincerely hope this will materialize in 2026. The last point was macro catalysts. I mean, the key question is whether U.S. markets, U.S. economy will get a genuine Fed pivot when it comes to monetary policy and rate cuts, or it will just be a continued confusion, as it is the case right now. So also something to keep in mind is that the current Fed chair, Jay Powell, his mandate ends in May 2026, and Trump administration has already a short list of candidates for replacement. So this will also, in a way, or is expected to affect or change the course of monetary policy, which will then, by extension, impact risk-on assets and equity and crypto. So it's something to pay attention to. If the Fed could cut or would cut more aggressively, that would be, in my view, that would be or could be very constructive for risk assets in a broad sense. But as I mentioned, Fed is at the moment, they're just projecting uncertainty, and due to this fact, crypto will remain volatile, and this correlation to US equities, in my view, will stay elevated. Reason for that is that in the United States, or when it comes to crypto industry, the majority of investment capital, the majority of startup headquarters come from the United States. And this sensibility to US monetary policy or regulatory changes, politics, is affecting crypto in a broader sense. That's why also the crypto markets reflect that. So we also talked about geopolitical developments. I think, as mentioned, that matters more than it used to matter a couple of years back. And Venezuela escalation and Japan, China, Ukraine, we still have tariff policy developments, how this is going to change. A lot of question marks actually for 2026. So it's very challenging to give an answer, because too many developments that change too often, too fast, and it's very challenging to stay on top of it all.
Different people have different understanding of the word constructive, right?
Okay.
Yeah. So you've mentioned quite a few interesting points, but can we get a bit even deeper than that?
Well, what I meant with more constructive, what would make my view, my expectations more constructive, when it comes to Bitcoin, when it comes to crypto markets, cleaner positioning for me would be, I would say, one of the first data points to pay attention to. Things like leverage metrics, funding rates, open interest would need to normalize, to stabilize. We are getting there, but we are not quite done. I mentioned earlier that we are rebuilding slowly after this flash crash, and you really have to reconstruct certain, let's say, microstructure, and also when it comes to price technical levels, but also infrastructure-wise, to get market makers back in the books. because some of market makers got fully blown out. They're like lost all the capital or majority of the capital. So there are a lot of different outcomes when it comes to the segment market makers. And we need, of course, market makers to rebuild the order books and tradability or availability of certain altcoins. And when it comes to majors, altcoin majors, as I've mentioned, we've had the conditions where everybody who wanted to be long was long with too much leverage. And in this context, I would like to see more cleaner positioning. After this reset, all these metrics that I've mentioned, like funding rates and open interest, would need to stabilize and normalize. So this will also take a bit of time. Another point for me in this context of being more constructive or seeing more constructive signals is the institutional capital formation. I would like to see sustained ETF inflows, net inflows, new DAT or new corporate treasury allocations. This DAT trend, as mentioned, is in the right direction, but not all DATs are created equally. I really have to mention that. I feel the need, and I need to emphasize this. There is also a lot of DAT garbage out there, and people do not know that and think that getting exposure to certain fundamentally good digital assets over the path of DAT is like, there's no difference. DATs, they are all the same, but they're not all built or created all equally. So you have to also pay attention what kind of DAT is it, as this is also an attack vector for scams and just taking people's money. Another point ties into this already mentioned infrastructure improvements. Maybe better custody frameworks, regulatory clarity in other major jurisdictions outside of the United States. I think there are positive developments in this context in Japan already. Improved risk management when it comes to centralized exchanges. Regarding Bitcoin, I'm not looking or expecting for Bitcoin to hit new all-time highs immediately. In this sense, rebuilding will take some time. But I'm looking for sustainable infrastructure that can support the next, let's say, phase or leg of institutional adoption without breaking apart or breaking down during a next stress phase or outlier event. So, or even to break down because it runs on AWS, as we had it as well in the meantime, where AWS and Cloudflare broke down, which meant that some L1s and the majority of L2s were like not working, which is for me ridiculous.
But to be fair, not only Web3, but
I know, but
Web2
it is ridiculous for me in the sense that certain blockchain infrastructure is built on, let's say, centralized infrastructure. So open, distributed, decentralized systems have certain level of independence that was not in place when AWS broke, which just like exposed this.
Yeah.
So it became clear that certain blockchain projects were actually just centralized server running in the background. Mm-hmm. And once AWS broke down, it's like, oh, our blockchain is not producing blocks. Ideally, for a blockchain, open, permissionless, distributed blockchain network, network participants run their own nodes, mm-hmm. and not on a rented server somewhere, for cheap, hosted at AWS. Anyways, in this sense, I was like, this is really ridiculous. Mm-hmm. But it exposed also those flaws. For me, the opportunity in crypto and digital assets industry remains enormous, really, really enormous. So we are still in early stages, and despite the past 15 years, achievements in those 15 years, I think we're still in early stages of institutional and broader retail adoption. I mean, maybe this is a reality check for a lot of crypto enthusiasts. The next stages, in my view, simply necessitate building better infrastructure, not just hoping that the volatility of asset prices, crypto asset prices, is going to die down. For investors, for mid and long-term investors, time like this are typically when you have the opportunity to get the best long-term entry points or entry prices, after major deleveraging, with cleaner positioning that I mentioned, and those discount prices. It's like having a fire sale or Black Week for quality projects. Like now we have this Black Week and everybody's talking about major discounts, -30, -70, -80%, go shopping. In a way, this is what you have right now for certain high fundamental quality projects. So fundamental
Black Friday and
Friday, yeah.
That's a good self-esteem of this industry.
Exactly. So if you have fundamental quality of certain assets is the same, nothing changed. But now you get better entries if you are mid and long-term investor, which is definitely something to consider to take a look into if you want to have exposure to digital assets.
But also if you're a builder, so besides the investment part, right? If you're a builder, vulnerabilities are exposed, as you said, better infrastructure and maybe better solutions can be created.
Yeah.
And they are evidently needed, the demand is there, right?
Definitely, you're right. And this is, in a way, also an opportunity for new investors who now have a clear picture of weak points, which, depending on their specialization, can give them opportunities to invest and to improve this infrastructure and build something new and generate revenue, which is like, it can result in a win-win-win for everybody included, despite this short-term, very painful experience for many.
Igor, thank you very much for breaking down this complex market dynamics.
Thank you.
You distilled a lot of things, right? A lot of points, and it was a pleasure to listen to you. And thank you for sharing your insights on what's ahead as well, right? For listeners who want to dive deeper into what you're doing, or these topics in general, how can they find you, and where would you recommend them to find, more information?
Thank you, Nasib. Of course, anyone interested can follow our research and market updates on or through our Venionaire channels on social media, our channels on social media. You can contact me on LinkedIn. My DMs are open. I am often a guest or a speaker on local Web3 focused events in Austria here. So if you are around and you do visit some of our events, just approach me, say hi. Let's share knowledge. Let's establish network, because local community is still growing and we need to support that growth. Also on LinkedIn, reach out to me. My DMs are open. And thank you for having me once again. It was a pleasure.
It was a pleasure. And to everyone listening or watching, if you like this episode, subscribe or follow, and share this episode with someone curious.